Hello, and thank you for joining us for our third quarter 2020 economic and market wrap-up. This video is thought to be a complement to the written investment commentary that we send out quarterly. So if you're not receiving those and you would like to, please let either one of us or your wealth advisor know, and we'll get you set up to receive those on a quarterly basis. Bob, investors have a lot to take into consideration at the moment with the upcoming election and obviously the continued effects of COVID-19. So let's dive right in and explain how we're digesting all the information that's driving markets as we near closer to the end of this calendar year.
Well, thanks, Adam. I do think it's important to state something up front that is very important, and that is that nothing that's going on in the world today would cause us to recommend that someone adjust their long-term allocation to equities. So whatever your allocation to equities may be in order to help you achieve your long-term investment goals, we think you should stay the course. Now, on a shorter term basis, we think there are a lot more questions. In the past, we have been very open with you about when we think it's time to be bullish on the markets, as we were earlier this year. We've also been very open with you when we think it's time to be cautious. Well, we sit today in a very different position, what we're describing as decidedly neutral. And frankly, it's not all that fun of a position to be in, but hey, that's where we're at. Why is that the case? Because there are a lot of cross currents in the market right now, which, depending upon how they are resolved, could dictate the direction of the market. So if we were to look at things with a glass half full view, we'll say there are a number of genuine positives in the market, the most important of which is likely the Fed support, which the Fed has currently provided unprecedented support for the economy, so much so that if a gun were put to our head and said, hey, you can't be neutral, you got to be either positive or negative, we would probably be positive for this reason alone. The economy, while it is struggling, has performed better than expected. U.S. corporate earnings, which have declined notably, have actually come in better than feared. There is going to be a vaccine coming out, even if we don't know the exact timing of it. And we know from history that once the outcome of the election is known, that's typically positive for the markets. Now, if we were to take a glass half empty view, well, there are genuine concerns out there as well. The economy is indeed struggling. As most folks know, consumption represents about 70% of our economy. So we're very focused on the labor markets. And in that regard, there are some struggles. The good news is that we've recaptured somewhere between 10 and 11 million of the jobs that were lost in the heart of the pandemic earlier this year. The bad news is we probably got another 9 or 10 million to go. So that could be a little more difficult. As a result, we're looking about on the potential impact that may have on personal consumption. And in that regard, there's reasons to pause. Personal consumption growth was nice in May, but since that time has started to trend down such that it is making us pause. As of the recording of this video, there is still no additional stimulus package that has come out of Washington, and we think the probability is such that that will not occur. And there's some questions around the outcome of the election. What will the tax regime be? What will the regulatory regime be? And then finally, there are some valuation issues as well, as the market is currently expensive. So you take the positives on the one hand and the negatives on the other. What does that mean? That means we're decidedly neutral, which isn't a fun place to be, but we do think it makes sense to step back and see how some of these things play out. So Adam, how about sharing with us some of the key economic variables that we're looking at today?
Okay. As you may recall, we featured this particular slide in one of our videos this summer as an area that remained a lingering concern for us. That is still very much the case. Initial weekly jobless claims. This is a chart showing people who, as recently as last week, filed for unemployment insurance for the first time with their respective state unemployment agencies. So while the overall unemployment rate has come down significantly because many of those who lost their job in the early part of the pandemic in March and April have since been rehired. This data set here shows that people are still being laid off currently, and that remains concerning on a go-forward basis. Prior to 2020, the highest one-week total for new unemployment claims was 695,000 people. And that occurred in October of 1982. Last week marks the 32nd consecutive week where reported initial jobless claims were higher than that pre-pandemic one-week record. So obviously this speaks to a major problem with our economy. Now, Bob and I often hear the question posed, well, how can the stock market be doing so well when so many people out there are losing their jobs? that's a perfectly fair question. So let's look at one reason why. This is a chart showing the expansion of M2 money supply. M2 is sort of a wonky economic term. It measures the supply of money in our economy. It includes cash, checking deposits, money market securities, and other short-term cash instruments. Now, the Federal Reserve, our nation's central bank, has been given a dual mandate to both support a healthy labor market and to do so while containing inflation. And as we just saw, the labor market is struggling. One of the tools the Fed uses to support economic activity and ultimately the labor market is to manipulate short-term interest rates. Lower interest rates means less borrowing costs for people and businesses, which leads to more economic activity and ultimately more hiring and even higher wages. One of the ways the Fed affects interest rates is by modulating the supply of money through a process that involves the buying and selling of fixed income securities. When the Fed buys a bond, they're adding money to the money supply. Now, the growth in M2 typically occurs without any of us being able to even notice it, and it happens fairly steadily over time, except during recessions, when the Federal Reserve adopts expansionary monetary policy. And during those times, the growth of the money supply is more dramatic. The Federal Reserve increased the money supply significantly in 2001 and 2009, and they did so to help our economy come out of a recession. But that pales in comparison to what they've done this year in 2020 during the pandemic. The challenge today is that the virus is slowing our economy's ability to circulate that money and ultimately get it into the hands of those most economically affected by the pandemic. Now, if you were to take that reality and couple it with low stock prices, well, we would happily adopt a more bullish posture. In fact, that was the message that we were delivering earlier this summer. But as Bob will explain in a minute, at least to some degree, the stock market has already anticipated the positive effect of this Fed action. So, Bob, where do we stand on the valuation of the market currently?
Well, Adam, we've a long time said that we think the ultimate driver of equity prices is corporate earnings and the growth of those corporate earnings. And so let's take a look at where we stand today. If you look at the table on the left there, the current consensus on Wall Street is that S&P 500 earnings are going to decline by around 18% this year. That's not good. But to the extent there's good news is that earlier in the year, the expectations were that earnings were going to decline by about 25%. So things have gotten a little bit better. Now, most investors today are looking out to 2021 and what the earnings picture is going to look like then. Currently, the consensus for 2021 earnings is a S&P level of around $165. That would suggest earnings growth of around 25% or so. I will say up front that we're a little more skeptical of that level, but that is the current consensus. So if indeed that's the earnings level for next year, what should the valuation of the S&P 500 be? Well, the table on the right is a valuation table. For a historical perspective, the S&P 500 typically trades at a market multiple of 16 times projected earnings. Okay, so what does that mean? That means if we take the 16 and multiply it by the 165 that's projected for next year, then fair value for the S&P 500 should be around 2640. That's actually a troubling number because as we sit today, the S&P 500 is around 3450. But let me ease your concerns right away. There are a number of reasons why we think the market should be trading higher than historical norms, notably because interest rates are very low and earnings currently are depressed. We actually think a more appropriate multiple, as we highlight in the table, is 20 times projected earnings. So if we apply that 20 multiple to the 165 in earnings, that would suggest fair value for the S&P 500 of around 3,300. Again, that compares to a level today of around 3,450, so just slightly below where we're at today. However, as I noted, we're a little more skeptical on the outlook for earnings next year. And so if we took a more conservative approach and project earnings at around 150 as opposed to 165, then that suggests fair market value for the S&P 500 of around 3,000. A little more meaningful pullback, somewhere in around 12 or 13% or so. And that's why it tells us that the market is currently pricing in a much healthier economy in 2021 and much healthier corporate profits for next year. Now, why would the market be doing that? Well, one of the primary reasons is that we made a lot of good progress in our fight against COVID-19. We do have treatments that are out there or on the way, and we have vaccines that are forthcoming. On the treatment side, we already have one treatment that's approved by the FDA, a drug called remdesivir by Gilead Sciences. There's also a steroid that's being actively used that has shown good clinical data. And we have two large companies, Eli Lilly and Regeneron, that have a treatment in advanced trials that could be approved within the next couple of months. On the vaccine side, there are almost 200 vaccines in development. We're most focused on the 9 that are in phase 3 clinical trials. What does that mean? Phase 3 trials means that they're being conducted on humans to determine the effectiveness of the vaccine and the safety of the vaccine. So where we sit today is Pfizer is probably the leader in the clubhouse. In fact, we expect data from their vaccine trial to come out within the next couple of weeks, such that they could be able to file for emergency use regulatory approval by the end of November. And they'll be able to deliver 100 million doses by the end of the year and over 1 billion next year. Johnson & Johnson also has a vaccine in advanced trials. We think that approval for that could come in early 2021, and they're going to be able to deliver 1 billion doses of their vaccine. AstraZeneca also has a drug in advanced trials, and we think data for that could come out by the end of the year, such that they may have a vaccine approval by the end of the year. So there are a number of other companies as well, whether it's Merck, Moderna, Novavax. The key message is that it appears we've made good progress on the vaccine and treatments. And while we're not at the finish line right now, the street is optimistic that we will be, which is why the market is likely trading at elevated multiples today.
Okay, great, Bob. That's very helpful. I don't think the globe has been so laser focused on any one event in our lifetime as it is right now with the arrival of a working vaccine. So let's keep our collective fingers crossed. As you may have noticed, in this video, we didn't talk a whole lot about the upcoming election. It's our intention to produce another video once the outcome of that election is known. So please keep an eye out for that. But as always, if you heard anything today that sparked an interest or a concern, please feel free to reach out to myself or Bob or your wealth advisor directly. Investors Trust Company is here to help. Thank you very much.
Thank you.